All right, guys, today we are going to compare the two biggest loan programs out there. It's the most epic matchup, like DC versus Marvel, LeBron versus Kobe. We'll leave Michael Jordan out of it because we all know he's the best. And, there's a lot of myths and misconceptions about the conventional and FHA, so we're going to break that down for you as well because recently, in the past few years, they've become a lot more competitive against each other. So it's not always as clear which one's going to be the best option. So that's what we're going to help you determine today. All right, round one. We're going to start with the low-hanging fruit, the one question that everybody already knows to ask, and that's the interest rate. Which option has the best interest rate? And that one is cut and dry, clear winner. The FHA loan is always going to have a lower interest rate. It's a government subsidized loan, so they're carrying some of the risk, and that allows lenders to offer much better rates. And then, all the lenders are competing against each other. So across the board, you can get a much better rate on FHA, although some lenders will try and pocket that extra that extra gap in the rates. And so you got to be careful who you're going through because they can take that margin and keep it for themselves. Okay, and on the conventional loan, a lot of people already know this, but the rate you get on the conventional is very sensitive. It's based on your credit score, your debt to income ratios, not as much, but that comes in, and then also your loan to value, how much down payment you're putting down on the house. Hopefully, we know by now, conventional does not require 20% down. You can go as low as 3% down, but that all factors into the rate that you're going to get. The difference, it's about 0.5%. So if a conventional rate's 6%, which we're pretty close to being around there right now, which is great news. That's the best we've had in about 3 years. FHA rate is going to be about 5.5%. What conventional loans have done, not super recently, but for a while now, they have first-time home buyer programs. They're called affordable home programs. There's a couple of them out there, but for first-time home buyers, not always. They open these boxes, so basically everyone can fit in them now. So most people, you can get into this affordable program. It limits the pricing adjustments on your interest rate, credit score, down payment, debt to income ratios, those things I mentioned before. They kind of limit how much that can raise your interest rate. So it helps more people get a conventional loan if that's the way that you want to go, to help you get a more competitive rate versus the FHA. So it kind of like narrows that gap. So more first-time home buyers can do a conventional loan. All right, round two. This is something that less people know to compare. They're less worried about. They know they're going to have it. It's the PMI, mortgage insurance, but people don't necessarily know how to compare that between different loan programs. And this is more of a make or break than the interest rate, I would say, on which option's better for you. So FHA loans is the more simple one, so we'll start with that. It's on your normal 3.5% down payment. It's going to be 0.55% of your loan amount per year. They divide that by 12 to get your monthly amount. So that means nothing to you. So let's give an example. So $500,000 purchase price on your house. You put down the 3.5% down. Your monthly mortgage insurance is going to come out to $220 per month on the FHA. In most cases, the FHA rate is higher, but again, that depends because on the conventional, there's a very wide range on what your PMI cost is going to come out to. So most people that go conventional, they have traditionally higher credit score, more down payment. Credit score is the most important factor here. Your mortgage insurance rate on conventional, it can be very low, much lower, $150 a month on that same example of the $500,000 house, so $70 a month less starting off, on just based on a 780 credit score. For that same conventional buyer, change their credit score to 680, which is still pretty good. That's not a bad credit score. If you have a 680 credit score, you're paying your bills on time, you're doing good, like, you don't beat yourself up for that. But on the conventional loan, that changed the mortgage insurance from $150 a month to $380 a month. So if you're like below 700, in most cases, conventional, not a great option. So you can kind of weed it out pretty quickly based off of that. So the advantages on the conventional, other than, a lot of times you can get a little bit less up front, it also, it can be removed. So your same loan, you don't ever have to refinance it, pay those fees. You can just stay in that same loan. After a few years, you can petition your servicer to get it removed if you think you've built up enough equity. So if, the market's, you buy the house, the market goes up. After 2 years, I believe is the minimum before you can petition that. If you don't do anything at all and just let it run its course, it will eventually lower that down after 7 years, and then eventually it does come off all on its own. Or very likely in this scenario where rates are going down, you buy the house now and then you refinance in 3 years, you get a new appraisal comes in higher, and you can get it recalculated or removed during the refinance. Versus with the FHA, if you put down 3.5%, you're paying that $220 a month on that example for the life of the loan. So if you just stay in that same loan, you're paying that for 30 years. That's going to add up to tens of thousands of dollars more over the life of the loan, even though initially, it's only like $70 a month difference. It can add up to a lot more than that. How many people keep their loan for 30 years? I might know 1 or 2 people out of everybody I've worked with. So not very likely, but, in theory, you could be stuck with that. If you put down 10% down or more, it comes off after 11 years on the FHA. So there's different brackets you can get in based on the down payment. So we can go into that more later. Okay, round 3. Conventional loan is just going to get a nice uppercut to FHA on this round because this is just a drawback. It's bad, no benefit to it. But on an FHA loan, not only are you paying the monthly mortgage insurance, but you have a one-time upfront mortgage insurance premium. I bet people have FHA loans and don't even know that they paid this. It's, your loan officer may not even tell you about this. It's just kind of slid in there under the radar. But basically, they're going to roll that back into your loan. It's big, it's significant. 1.75% of your loan amount. So on that $500,000 house, you're going to put down $17,500 as your down payment. That's 3.5% down. They're going to put 1.75 back in. So that's half your down payment is basically just incinerated, disappeared. So you pay down 3.5, then they add 1.75 back in. So your starting loan amount is just a bit higher. So it's like $490 versus $480. So on the total loan amount scheme of things, it's not much different. It doesn't change your monthly payment very much. So it is a very efficient way of handling that fee because you won't notice month to month much difference because of that. But the big drawback would be if you are gonna refinance or sell the property. Let's say you buy that house 2 years later, you want another one. Well, that's over $8,000 in equity that you're not going to get back when you sell. Conventional there's nothing like that. Doesn't exist. So you're $0 versus, 8,000 plus. Okay, round 4. This is aside from the numbers, which we've covered most of those by now, but this is the actual process. Once you've been pre-approved, you're going out, you're looking at houses. What's the difference going to be from there? The actual getting it accepted offer, closing on the loan, ease of the process, what are the pitfalls, chances of things going wrong. Long-standing stereotypes and assumptions out there that the conventional is a much stronger offer. When you put in your offer, your pre-approval letter is going to tell the seller what type of loan that you're pre-approved for, so they know what type of financing you're going to do. They don't know your credit score. They don't know where you work, how much money you make. They don't, all that stuff's private. You don't have to share that. But the seller's going to try and, determine all of those things indirectly by the type of loan you're getting. So you put an offer in with a conventional loan, they're going to assume you have better credit, you make more money, you have more money for down payment, they think you're a stronger buyer. Not necessarily always true. We close a lot of loans on FHA with people with 800 credit score, just because when it's a better loan for them for whatever their individual situation is. But that's a reality that you got to deal with. So the second thing is more of a real difference, and that's going to be with the actual property condition. If you're doing an FHA loan, they have minimum property standards. So when the appraiser goes in, it's a special FHA approved appraiser. They're going to look for certain minimum standards. There can't be any peeling paint on the property. Anything like 3 steps or more has to have a handrail. So like front porch, 3 steps, no handrail. That's going to have to be fixed by the seller. So some of them are a bit frustrating, but then, a lot of times if you're looking for a fixer-upper, you want to get into a good neighborhood, so you're buying something that's a little rough around the edges, so you can move in and kind of make it your own over time. Conventional may have to be the option on that. You'll have less issues and problems that can pop up along the way. And that's a very real fact that you want to consider, is, the property you're buying, is there going to be any problems? So on that one, conventional is the way to go. It's just the way it is. Okay, round 5. This is going to be going back to your pre-approval. There is a difference, obviously credit score, but aside from that, how much you can get approved for, your total pre-approval amount. And this is kind of the main reason I see some people go in FHA when they could get approved for both. They have good credit. They could go either way. The FHA has an advantage here. They have higher maximum debt to income ratios, multiplied by the lower interest rate, lower monthly payment potentially based on the PMI portion too. But lower rate, higher debt to income ratios, you multiply that together, the total amount we can pre-approve you for is almost always going to be higher on the FHA. So if there's a specific house that they want or a target, they're going to need that. We don't want to get you into a house you can't afford, but there's certain scenarios where you need to push those limits. Like if you already own a house, you're going to be selling it, but you're buying the new house first, moving your stuff over, then selling the old house, which is much easier way to do it. That's how I've always done it. I've been able to pull it off. Sometimes it's hard to get that approval through that way, but then you just move at your own pace. A lot easier to sell a vacant house. Once all your crap's out of it, you can touch up paint, carpet, make it look nice, sell it for more. You're not in a rush to hurry and get it sold. So in that scenario, yeah, you might need the FHA to get you that extra debt to income wiggle room so you can get approved both loans at the same time. Also, you know, people get divorced, breakups. So like, you know, you're dating someone, you buy an auto loan, you sign on your girlfriend's car, your spouse's car, then you break up, they move out, you know, they're driving the car, but your name's still on it. You're getting dinged $500 a month. These days, I mean, that's maybe a little bit low. Maybe $1,000 a month these days, you know, you never know. But, you know, you're getting dinged for a debt that's not yours. The FHA loan, you know, you can still get approved with that counting against you. You know, there's always ways, if you can get the documentation, that you can exclude those debts, but that, you know, that means contacting your ex, having them on board to participate and help you out. So that's not always an option. So yeah, FHA, big advantage, getting approved to begin with. You can, you know, just approve versus denied on credit. The FHA is a lot easier. And then also, you know, getting approved for a higher amount. I mean, there is advantage on the conventional loan. There's more wiggle room with job history. You know, part-time, self-employed, gaps in employment. Conventional is a lot looser on those. So, I mean, depending on the situation, it actually could be easier to prove conventional, but just in most cases, 9 out of 10 times, the FHA is going to be easier on that regard. All right, final round, the consensus. Here's where you're expecting me to tell you which one's better. Neither one is better. It all depends on your scenario. So if you have a good loan officer, they'll give you both options. Most won't. I mean, they may work up both in the background. That's their job, and tell you like, hey, this is my recommendation. But you'd never know if they're, you know, running multiple options in the background behind the scenes. So don't be afraid to ask those questions. What I would recommend is, you know, when they present you with an option, if it's conventional, say, what about FHA? Or if it's FHA, say, what about conventional? Or are there any other options besides this one? And see what their response is. You know, if they're acting annoyed that you're asking questions, then, you know, that tells you a lot about the loan officer. You know, maybe they're not the best option for you. A good loan officer, you know, wants to educate. They don't mind taking the time explaining things. They're not going to be offended if you question things. You know, they're not going to take it personally if you're, you know, like, yeah, what else is there? Is this the best thing for me? Are you sure there isn't anything else, you know? So that's my takeaway. All right, guys, hopefully you're still awake. Hopefully that was informative and interesting, not too boring for you guys. If you have any other questions, feel free to drop a comment, and I'll have all my contact info shared at the end of the video as well. Thanks, guys.